Alright, welcome back to the channel, guys. So far in 2022, the stock market has been extremely erratic, and all indications point to that continuing at least through the end of the year. So in this video, I'm going to be laying out my entire thesis on how I plan to potentially outperform the market in 2022 as an income investor. And I really do think there's a lot of value in this video, so if you guys enjoy, leave a like, subscribe, all that kind of YouTube stuff. I do greatly appreciate it. But let's get started here. Okay, so first I have to begin with my assumption of the stock market in 2022. And my very basic prediction of the stock market is something like this for the rest of the year. A lot of volatility, generally moving sideways, and ending the year probably a bit higher than it is right now. So this is my pretense and my background thinking for everything else I'm about to say. So there's two major reasons why I believe the stock market is probably going to look something like this in 2022. The first reason is the war in Ukraine and all the uncertainty that's going to bring to the US financial markets. And the second major problem here is inflation. So I think the combination of all of the geopolitical uncertainty brought by the Ukrainian war and the monetary situation here at home is going to contribute to a stock market that looks like this with a lot of volatility and not that much upward gains throughout the next year. Okay, so let's tackle the first issue here, and that is the situation in Ukraine.
As Russian troops face unanticipated setbacks and losses in Ukraine, President Vladimir Putin is waving his biggest sword, putting his nuclear weapons on high alert.
Now, real quick disclaimer, the entire situation happening in Ukraine is extremely heartbreaking, and I definitely support the Ukrainian people, but for the purposes of this video, I'm only looking at it through the lens of how it's going to affect US equity prices. And the main impact in this sphere is the extremely high level of unpredictability this is going to introduce into the stock market, and if there's one thing investors don't like, that's uncertainty. Probably nobody even anticipated that this full-scale ground invasion was even going to happen, but so far the Ukrainians are defying the odds, putting up a very valiant and steep resistance to Putin. But honestly, as I said right here, the whole situation is extremely unpredictable, and in a week's time, there's really no telling what's going to be happening. And that's why the VIX right now is at a very high elevated level, because this is a measure of general volatility and fear in the market. And as new information develops on this whole situation, I'm sure the markets are going to have very violent responses to it, so be ready for that. Now, the second issue is inflation and interest rates that are going to be used to combat that. And generally, when it comes to this issue, when interest rates rise, asset valuations go down, and that's mostly due to the discounted cash flow model. I'm sure you guys don't need a whole background lesson on this, but I got a few quotes from Warren Buffett on the whole topic of interest rates. And to me, these are pretty insightful. Interest rates are like gravity in valuations. If interest rates are nothing, valuations can be almost infinite. If interest rates are extremely high, that's a huge gravitational pull on values. And finally, and perhaps most importantly, I like this one a lot. There's nobody whose predictions on interest rates I would pay attention to, even myself or Charlie. And that's important to keep in mind whenever you see articles on what's going to happen with interest rates. Nobody actually knows what's ultimately going to happen. But currently, this is what we know about interest rates so far. So currently, interest rates are next to zero in response to the pandemic in 2020. And here I have the federal funds rate side by side with the S&P 500. And we can see some general correlations over time. And currently, the stock market on all accounts is extremely expensive, mostly due to the extremely low interest rates. But as I'm sure you guys are all aware, this is going to be changing next month. So Jerome Powell says Fed is poised to raise interest rates for the first time in 3 years to fight inflation despite Ukraine war and the market sell-off. And over the past couple of months, as we've been getting more information from the Fed, the valuations in the stock market have been adjusting to reflect the new situation. And the corner of the market that's been affected by this the most is the very high valuation tech sector represented by the ARK Innovation ETF. Okay, so that's my recap on the current market situation and why I think the stock market in 2020 is going to look something like this: high volatility and limited capital appreciation throughout the entire year. And of course, the two main causes are the Ukrainian war and all the uncertainty, and inflation and interest rates. Now, in terms of my plan and what I'm trying to do to outperform this potential weak market, it's focusing on cash flow, and more specifically, a combination of dividends and covered calls. Now, if you guys follow the channel, you know that I always talk about this. This is my favorite way to invest, but I have to say, I think in 2022, this is going to be extra important, especially if this situation plays out. And let me explain why, beginning with dividends and how they act during inflation. So in green here, we have the S&P 500 Dividend Aristocrats Index, which represents dividend growth companies. And in blue, we have the Dow Jones US Select Dividend Index, which represents high dividend yield companies. This data is from 2005 to 2015, and we have 3 different periods of rising interest rates, falling rates, and the full overall period. And the clear trend here is that dividend growth companies perform well during all situations. And it's really important to make that distinction between high yield companies and dividend growth companies. So it says right here as a key takeaway that a dividend growth strategy, while yielding less, potentially offers an all-weather and evergreen equity solution, one that has historically outperformed regardless of the direction of interest rates. And if we come down to my next figure right here, this is the average annual returns and volatility by dividend policy from 1973 to 2020. And again, this piece of data shows that dividend growers and initiators perform the best, even outperforming the overall market. And not to mention, it's done that with less overall volatility. So when it comes to dividends and a rising rate environment, it's important to focus on dividend growth over high yield, because these high quality dividend growth companies have proven themselves over time to be extremely resilient in a lot of different various market conditions, including rising interest rates. And that's also why when it comes to the other main issue of the conflict in Ukraine, I'm also confident that dividend growth companies are a fantastic solution to this dilemma. Now, the only issue with that is when you focus on dividend growth, you don't have that much of a yield, and if the stock market is indeed flat, you're not going to have great returns. And this is where the second component of covered calls comes into play. So you can use covered calls to boost yield and thus the total returns of your investments. But let's see how covered calls react to the high volatility caused by Ukraine as well as inflation. So when it comes to having extremely high levels of volatility in the market like we have right now, the relationship with options here is that the higher the volatility, the higher the option premiums. Option pricing, the amount per share at which an option is traded, is affected by a number of factors, including volatility. Implied volatility is real-time estimation of asset prices as it trades. Implied volatility tends to increase when option markets experience a downtrend, the opposite when the market goes up, and larger implied volatility means higher option prices. And that right there explains why QYLD has a higher dividend yield than XYLD, because the underlying index is just more volatile for QYLD, allowing it to generate a higher option premium. And if we look at the most recent dividend payments from XYLD, we can see how they've been the highest ones on record as the volatility in the market is spiking. So when it comes to the effects of the Ukrainian crisis on call options, they're actually positively impacted by this. And then the final question here is, what's the impact of rising rates on call options? So as mentioned, call options have many factors that affect their pricing, including, as we just talked about, implied volatility. But another one is the risk-free rate, aka the interest rate. Now keep in mind, this probably is the smallest factor at play here in comparison to the others, but the effect is as following. In general, and with all else equal, an increase in interest rates will drive up call premiums and cause put premiums to decrease. So just like before, with the high level of volatility actually benefiting call options, when it comes to interest rates to a much smaller degree, it kind of has the same effect. Okay, so finally, if I come to my summary here, in 2022, there's 2 main risk factors: rising interest rates and all the uncertainty and volatility associated with Ukraine. That leads me to believe that the stock market is going to be somewhat flat in 2022 with a high level of volatility. My response to this, in order to maintain a level of return, is both dividends and call options. As we saw, dividend growth is very resilient in a variety of market conditions, and it's also a good hedge against inflation if the dividend growth rate is higher of that than inflation. And not to mention, the dividend policy of a company is set internally by management. And thus, historically speaking, the returns from dividends are way more reliable and stable than the asset price itself. Just keep in mind to focus on dividend growth and overall quality names. And finally, I use call options to boost that dividend income and raise my overall return, especially in a flat market. And when it comes to the effects of both volatility and interest rates on call options, the income level actually increases as the volatility goes up in the market. So it's a great hedge in that aspect. And finally, in terms of interest rates and its effect on call options, The income here also slightly increases as interest rates go up, but the effect is going to be very minimal. So there you have it, guys. That's my whole thesis and my plan for investing in 2022. I think investing for cash flow is going to be extremely powerful in 2022, especially if we have a high level of volatility and weak overall total returns. And as we saw, both dividends and call options are both very resilient to both of the main issues we have in the stock market currently. But let me know what you guys think in the comments down below. If you guys are still watching and enjoyed, as always, leave a like, subscribe, all that kind of YouTube stuff, and I'll see you guys in the next one.